Morning, everybody. Welcome to the annual results presentation of Aedifica for 2024. We will start immediately with the presentations, but we use this opportunity to start the marketing of our Capital Markets Days that we will be organizing this year in Dublin, Ireland on the 7th and the 8th of May. So if you are interested, feel free to reach out to our investor relation Delphine so that she can invite you. Now, this being said, and I think by now we're well at 9:30 time that we should be starting, let's dive into the annual results of Aedifica. As always, Ingrid, our CFO, will be presenting the financial results. After her presentation, I will walk you through the portfolio, and we will, of course, spend some time on the outlook of 2025. Not sure whether the slide deck is actually, yes, okay. And maybe we can then go immediately to the, perfect. Sorry, we had a bit of a technical issue as usual when starting such presentations. So in a second, walking you through the highlights for 2024. I guess most of you have read by now the press release. So we have today a portfolio with a real estate value of 6.2 billion euros. We will be talking a little bit more about how value evolved throughout the year. This portfolio has generated a rental income of 338 million euros, so which is 8% more than last year, and it's actually also showing a 3.3% like-for-like growth. Resulting in 235 million euros of EPRA earnings, which is then leading to 4.93 euros per share EPRA EPS, allowing us to pay the dividend as announced of 3.90 euros per share. As you know, we are active in 8 countries, but exiting one of these countries, we'll talk about it. Looking at the pipeline and the portfolio, you will find, as usual, a healthy 19 years old, 100% occupancy rate, a pipeline that has made a turnaround, but we'll talk about it, and valuation that clearly has bottomed out and started growing again. On the balance sheet, without any surprise, I think, showing a quite healthy debt to asset ratio towards the end of 2024 with a strong credit rating. But these are topics that Ingrid will address, and I'm switching over to her now. There you go.
Okay, thank you. Let me start by saying that we can present to you solid financial results. So we will start first with having a dive into the EPRA earnings. EPRA earnings increased with 7% compared to previous year. First of all, there is the increase in the operating result, mainly coming out of the increase in rental income of 8%. You can also notice that the EBIT margin has improved. So last year we reported an EBIT margin of 84.9%, which improved this year towards 85.9%. There is a slight increase in the financial charges compared to previous year. This is related to the fact that the average amount of outstanding debt increased in the course of 2024, and there's also a slight increase in the average cost of debt towards 2%. Thanks to the high hedging ratio of almost 90%, we can still keep the average cost of debt at a low level. Then we have the corporate taxes. So there you see an important difference with the previous year. It's mainly related, that difference, to the impact of the FBI regime in the Netherlands. So in 2023, there was a one-off refund from the previous years of 9 million. And in 2024, we received a refund of 4.2 million related to the taxes that were booked and paid in 2022. So this leads then to the EPRA earnings of 234 million, or when we express it on a per share basis, it's 4.93 euros per share. And you would exclude the non-recurring FBI refunds, we notice that the EPRA EPS increased from 4.82 in 2023 towards 4.85 in 2024. Then moving over towards the net result of 204 million or 4.31 euros per share. The main variances that we see here are all non-cash items. So first of all, the changes in fair value of the financial derivatives related to the fact that at the end of the year, the interest rates came down. So there is some negative change in the fair value of the hedging instruments. Then the big change this year is coming out of the change in fair value of the investment properties. As already mentioned, portfolio valuation has not only stabilized in the course of 2024, but we see that it is also slightly increasing, mainly driven by a positive valuation on our UK portfolio, thanks to the strong operator performance in the UK. Then there's also some impact in the deferred taxes that are related to the changes of fiscal regimes. So this year we obtained the UK REIT status from the 1st of February, and that had an impact on the DTLs that were booked in the past and that were reversed in the course of 2024. Then the increase in rental income, plus 8% on a yearly basis. There is the positive contribution coming out of the indexation of the rent agreements, the deliveries and the acquisitions to the portfolio. You can see there is a small negative rent reversion. This is not related to the renewal of lease agreements that came to maturity that were at the end of the lease agreement. It's part of some minor renegotiations that took place in the portfolio and limited to a couple of assets. Then there is the impact of the disposals. And you also see in this line the contingent rent is only a small amount, plus 0.4%. 0.4 million euros. In the total amount of 338 million, the contingent rents, they contribute for 1.4 million euro. Contingent rents is something that we see mainly in the UK portfolio. So there we have clauses in place that if the operators have a strong performance, that there is a possibility to have additional rental income. This is something that we have started to show on a separate line item because it will have more impact in 2025, and I will come back to that topic later onwards in the outlook. Rental income, so when we look at it on a like-for-like basis, you can see the increase of 3.3%, which we can split in 3.1% related to the rent indexations. Then we have the minus 0.4% in the rent reversion. This is also including the contingent rents, and the 0.6% coming out of the currency translation. When you look at the different countries, you can see that in Belgium and in Germany, we are slightly below the number that you would expect based on the inflation that we have seen in those countries. In Belgium, it is impacted by the rent reversions. In Germany, it's related to the fact that there are certain thresholds in place, so the indexation will only kick in once those thresholds are reached. It's something that we expect for an important part of the portfolio to take place in 2025. Netherlands, Finland, and Sweden, there most of the indexations take place in January, so the number, the like-for-like number, has not changed in the course of 2024. And you can see that the UK, despite the fact that there are floors and caps in place, so the floors stand at 2% and the caps at 4%, that we can report a like-for-like that is slightly above the caps, thanks to the contribution of the contingent rents. Our debt to asset ratio, as mentioned, 4.3%. We have a financial strategy where we say that we want to keep this debt to asset ratio below the 45%, and we target or are comfortable with the situation around 43%. So this means that there is headroom on our balance sheet to, on top of the capital recycling that we are planning to take place in 2025, to add 300 to 400 million of assets and still staying within the financial strategy that we have set for the company. Then our financial debt, we have a total debt portfolio of 2.5 billion. Especially in the fourth quarter, we were active on the refinancing side. So most of the debt maturities have been handled for 2025. You can see that in the split of the financial resources, that those are diversified financial resources, and we have access to debt capital markets as well as to bank facilities. We still benefit from a BBB stable outlook rating from S&P, and we are considered as being a strong BBB. The interest cover ratio is at a comfortable level of 6.2 times, the covenant standing at minimum 2 times. Net debt to EBITDA stands at 8.5 times, average cost of debt 2%, and most of the financing is done on an unsecured basis, so we have very limited encumbered assets in the portfolio. As mentioned, so we have a well-spread debt maturity profile, and most of the refinancings have been handled for 2025. Post-closing, we have also signed an additional extension of a loan agreement. So the main maturity days for 2025 are now covered. The average debt maturity stands at 3.8 years, and we can cover our financing needs until January 2027. I've already mentioned the hedge ratio. So currently, we still have a high hedge ratio, around 90%, with an average hedge maturity of 4.4 years. Our financial policy is that we need to be hedged for at least 60% for the coming 3 years. But in practice, for the coming 3 years, we always have a much higher percentage. So what we will do now is start working on refinancings that are targeted for 2027 and 2028 to also make sure that there we can lock in some of the interest rates. So now I will hand over to Stefaan to give some more light on our portfolio.
Thank you. I will quickly walk you through some of the main features of the portfolio for 2024 and perhaps already looking forward to 2025. Now, in terms of the segment breakdown of the portfolio, no surprises in 24. So we remain with a quite high focus of 86% on elderly care and senior housing, with some 6% focus on childcare centers, which is exclusively in the Nordics and mainly in Finland, and 8% other care segments, which we still consider to be our playground, where we can explore other healthcare segments that might lead to future business lines. So in line with previous years, there might be some news about the geographical breakdown. Now, when you look at the slide and the graph, you will find that the 4 major countries still are good for 80% of the portfolio. And these are, as you know, Belgium, Germany, the UK and Finland, with more or less equal weights around 20%. The runners-up in the portfolio still are the Netherlands, but also and even more Ireland, which is now standing at 7% and which is a growing market for us. But I think the real news this time is coming from Sweden, where we announced recently that we signed an agreement to sell our LSS portfolio in Sweden, which, by the way, completed before the weekend on Friday. So we've sold the 22 assets, and we are in negotiations, in talks to sell the remaining 6 assets that we have, which are basically preschools and 1 school. So we are exiting the Swedish market. To us, this is clearly a capital recycling strategy that we are following, as we are convinced that the net proceeds of this divestment, once invested in today's market, will lead to a higher EPS contribution than is the case compared to when we're just sitting on this Swedish portfolio. So we are working on our cost of capital here. This being said, I think that the major news for us looking at 2025 is related to our tenants. What you see on the slide here is the tenant diversification. Once again, no major changes compared to the previous year. Clarion remaining our main exposure, but I'm signaling once again that our Clarion exposure is almost 100% on the Dutch and the Belgian market, where, as you all know, there is still a sales process ongoing, where Clarion might sell the Dutch and Belgian operations to a third party. So we are, as is the whole market, waiting for the result of that process. Otherwise, no major changes here, but, and I think that this is the most important slide, perhaps, or at least one of the most important slides today, the operator health, the operator performance keeps improving in Europe. What you see on the slide is the underlying resident occupancy for 5 of the countries for which we have sufficient data made available by our tenants. You clearly see that in countries like Belgium, UK, Ireland, the occupancy is now above 90%, which for the UK is a record high. And in countries like Germany, the Netherlands, we keep seeing improving occupancy, now reaching 86% in our portfolio for the mature assets. So first of all, if you would combine these 5 countries and try to deduct an average occupancy over the 5 countries' mature assets, you would reach at 90% right now. Couple of things to be said here. When we look at the ramp-up assets, which are not in these numbers, also there we do see an absolutely improved occupancy. So it's not just mature assets that are improving, but we also see ramp-up accelerating and getting to higher occupancy compared to the previous years. Like-for-like growth for the mature assets, you can see it on the slide, it remains quite important. And then maybe one comment, because there's one for us rather important country missing on this slide, which is Finland. The Nordics remain part of Europe where operators really are not willing to be transparent today, although we are making some progress now in the Finnish market. But what we can tell you about the Finnish market is that 2 of our main tenants, which are Mehiläinen and Attendo, have published themselves that their operating margins in Finland are improving in 2024. And that leads me then to the next slide, because occupancy clearly improving, but also as far as we can tell, operator margins are improving. The only totally transparent country here is the UK, and we are showing you once again the rent covers that we see for our UK portfolio, which once again are showing a sort of historic high. With a 2.5 rent cover at the end of the 3rd quarter 2024, but when we look back for 12 months, 2.3 rent cover. These are very high rent covers. We are working within Aedifica on the data collection from our operators so that we in the near future hopefully also can start mentioning rent covers for other countries. Today we have a 67% coverage of all of the assets in the portfolio in terms of data coverage, data collection from operators. But this is a number that we are willing and looking to improve in the near future. This being said, the UK showing record high operator performance, but what we keep hearing throughout Europe from other operators and what we see in the numbers that they make public is clearly that margins are improving. I already referred to the Finnish situation, tenants like Mehiläinen and Attendo that are good for 24% of our Finnish portfolio, clearly communicating improved margins. We've seen some of the major French players announcing improved margins, and when we have conversations with some of the tenants that you have seen on previous slides, we keep hearing from a lot of them that margins are improving, but even more importantly to us, that they are now thinking back about growing. So the conversations that we have are turning once again more back to doing new business, adding new assets to their portfolios and our portfolio, or joining in project development. So the market really is changing in that respect. Quick look at who the tenants are, and not specifically the names, but the profile. No surprises there. 90% of our tenants are profit-driven operators, so the private market. We do, as I mentioned, see improved margins there. 6% of our tenants are social profit players, 4% are public players. I think that I've said this before in the future, but we're starting to see more signs of it. We do see potential for growth in the not-for-profit and the public segment. Specifically in Finland, we keep doing business with the Finnish municipalities and or care regions, and it will probably also show in our future pipeline. But we now also see in some of the countries where we have quite important social profit markets that lots of social profit players also start turning to investors like Aedifica to finance their real estate infrastructure needs. So it is once again a market that is becoming more promising. Quickly going through some of the other features of the portfolio. What you see on the slide I already mentioned. The portfolio still is showing a quite important 19 years WALT and a 100% occupancy rate. Maybe also drawing your attention to the fact that only 1% of our leases will come to an end in the next 5 years. So there is not a lot of lease renegotiations due to the end of leases in the next 5 years. Maybe going then to probably also another more important slide today is what happened with the valuation throughout 2024. Now, starting with the fact that when you look at the situation end of the year, we are showing a fair value yield of 5.9%. If you're looking at the EPRA net initial yield, you will find that it's standing at 5.3%. But I think on the right side of the slide, and there the message is quite clear. Throughout 2024, we have seen that, first of all, at the beginning of the year, valuation was clearly bottoming out and stabilizing, and that towards the end of the year, we did see some marginal uplift in valuation. When looking at the countries, or maybe first of all, the whole of the portfolio, it means that for the 12 months, we've seen the like-for-like increase in valuation of 0.7%. Which is mainly coming from the UK and the Netherlands. Countries that are still lagging a bit behind are Belgium and Germany, but when we focus on the last quarter of the year, also for these countries, you clearly see that valuation is now bottoming out, and in the German market, even slightly positive, very slightly positive. Then, some color adding to the development pipeline of the company. I think here the message is very clear. We've made the turnaround in terms of projects that had been decided before 22 or early 22 based on the macroeconomic environment of that period. So these projects have now been delivered and are contributing cash flow for the group. Meaning that today we are focusing more at growing the portfolio again and refueling the development pipeline. Now, what you see on the slide is that when I said the turnaround has been made, it's now reflecting in the initial yield on cost of this development pipeline. We're now above 6%, so this is a territory where we want to be and hopefully even increase it slightly towards 6.5%. So there the turnaround clearly has been made. The number of 160 million euros is a relatively low number if you look at the recent history of Aedifica, but there we are now at the point in time that we clearly are looking to refuel the pipeline and expecting to see new projects being added to this pipeline. Projects that will be coming mainly also from Finland, where we are developers ourselves, but we're also expecting to see some projects in Ireland and perhaps in other countries in the portfolio. Which is now leading us to the outlook. And then if we have a quick look at the numbers here, maybe let Ingrid do the presentation first and then I'll pick up. Yeah.
Okay. So this is our outlook for 2025. So first of all, we are expecting a rental income of 355 million, an increase of 5.2% compared with 2024. This is based on an organic growth of 2.7% coming out of the inflation, the indexation. So there in most countries, we are expecting that it will be around 2% or slightly above 2%. Like I already mentioned in the like-for-like, it will be somewhat higher this year in 2025 for Germany. And we also expect contribution of contingent rents. So the contingent rents that we consider as recurring, the amount is estimated at 1.7 million sterling, is included in the organic growth of 2.7%. But we also expect in 2025 that there will be a catch-up on some lease agreements from previous periods, and that will have an impact of 3.2 million sterling. Then we have the increase in the EPRA earnings, 238 million. So an increase of 1.6%. So how to explain the difference between the increase in rental income and the EPRA earnings? In itself, we are expecting that the EBIT margin will stay around the 86%. And also in the financial charges, we only see a slight increase because the average cost of debt will remain at 2.1%. So the delta is coming out of the taxes, and it is related to the change of the fiscal regime in the Netherlands. For 2025, we are expecting that there will be an impact of current income taxes in the Dutch entities of 5 million. And on top of that, we do not benefit from the refund. So there you will have a delta of more than 9 million impacting the corporate taxes. Debt to asset ratio by the end of 2025, based on the assumptions that you can see on this slide, is expected to be around 42%. So which are the assumptions that we have included in our business plan? First of all, we have the deliveries from the pipeline, 110 million. We have the asset rotation, so 190 million. This is also including the capital recycling exercise that we are currently doing with the Swedish portfolio. So the asset rotation is a little bit higher number than what we have done in previous year. We have also included an assumption on new hypothetical investments of 250 million. And this assumption will be split between yielding assets and projects that will be added to the pipeline. On the yielding assets, we assume that it will happen a little bit more later in the year, so more in the second year half. The reason why we mentioned in the press release that the contribution of the new investments to the earnings is rather limited in our business plan because of the timing. If they would come in sooner in the year or for a more important amount, then we will adjust our EPRA earnings. Another assumption that we have included in this budget is related to the currency. So you can see the 0.87, which is a little bit of a conservative assumption if you look where GBP is currently trading. If we would stay around the current level, the 0.83, that would mean that there would be an increase in the EPS of approximately 0.06. We did not include in our business plan, as in previous year, an assumption on portfolio valuation changes. Based on those assumptions, we come to an EPRA EPS of 5.01 euro per share, and we give guidance for the dividend of 4 euros per share, which would mean a payout ratio of 80% of the consolidated EPRA earnings.
Yes, and maybe zooming in into two building blocks that you see on the slide here. The first one being the asset rotation. So the number that you see is relatively high, meaning that we do expect ourselves to see on a yearly basis, recurring basis, 0.5% to 1% of the total portfolio that is up for asset rotation. The number that you see is higher this year, but that has to do with capital recycling strategies. I'm referring to the Swedish exit that we're doing. So basically, you could expect that up to 75% of the number that you see on the slide are not older buildings that we're trying to get rid of and that are high yielding, but are basically capital recycling strategies where we are planning to reinvest the net proceeds of these investments and have a positive impact on the EPS of the company. Another building block, the 250 million euros of new investments. Maybe just drawing your attention to the fact that it is the first time in 3 years now that we are once again giving investment targets. So I think it's a clear indication that our expectations about the healthcare real estate investment market are clearly changing and becoming more and more positive. We are targeting both refueling our development pipeline and acquiring yielding assets on the back of an operator environment that is clearly improving. And this is bringing me then to the medium-term outlook. I think that the message here is, as far as we're concerned, quite straightforward. The company is absolutely ready for the second half of the 20s. Second half of the 20s that will be characterized by a growing demand for healthcare real estate on the back of demography. Aging of Europe will accelerate as the baby boom generation is starting to turn 80 and is growing older, but also on the back of improving operator performance. And I repeat that we're not just having conversations with operators about their margins, but we're clearly having more and more conversations about potential new business with operators coming from the operators themselves that are being faced now with this growing demand. So in a nutshell, I think that the company is ready for a new cycle and that we're looking towards it with a lot of optimism, notwithstanding the present geopolitical and macroeconomic environment. I think that we can end the presentation at this point.